Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Pulse for Friday, June 3rd, 2022. Hope you're having a great week. We're back to update you on the markets. We had some recent economic data released this morning that we're going to discuss, as well as some good price action in the market over the last week as the market tries very hard to defend that psychological 4,000 level on the S&P 500. So first, let's start with the economic data dump of the morning. We had the payroll report from the month of May released this morning, 8:30 a.m., showing an increase of 390,000 jobs in May, slightly better than economists expected, and the unemployment rate held at 3.6%. Now, a lot of folks were looking for some weakness in this report because yesterday we had the weekly unemployment claims, which did come in higher than they have the run rate for the past couple months. So there was some expectation there that that would be a leading indicator to some slowing in hiring. But nonetheless, we haven't seen it yet. Some recessionary chatter on the horizon. People have little fears that are starting to, I guess, grow a little bit about the possibility of a recession. But a data print like this is good and should go a long way to ease some of those fears. Let's take a look at the markets. The S&P, this is the S&P 500 over the last year. And as we expected, the market has perked up and shown some strength in that critical 4,000 level on the S&P, right? So that's a number, and it's not, it's not a perfect science, 4,000, 3,950, give or take. These are the levels that we want to see the market perform well at, show strength, and ultimately try to move higher yet again. Now, the growing consensus in the market, right, is, everybody's bearish right now. It's hard to find anybody that's bullish or optimistic about the future. And as contrarian investors, that tells us that a lot of this is likely priced into the market at this point. So when we look at this market and the trend that it's in right now, a lot of the pessimistic or bearish investors would argue that the market is in a 5-wave sequence down, and after the 5th wave will be completed and we'll resume up again. But when we look at this, let me just zoom this in a little bit. Basically, if you kind of just visualize this with me, they're looking at this as kind of 1, 2, 3, 4, right? So based on that, a lot of these prognosticators are expecting the market to make one more final low, right? Whether that's 3,800, 3,750, some people have suggested 3,500, and let's zoom out so we can see this a little bit better, right? 3,500, again, not that this is our view, but that would take the market to about here, okay? Now, what I think is interesting about this is that the indexes have lagged the overall action in the market for quite some time, right? We saw growth stocks started to fall long before the trouble showed up in the indexes. And now we believe it's the case that growth stocks have bottomed long before the indexes will bottom. And I think a lot of that, there's evidence in a lot of that. If you look at some of the names that we've spoken about in the past and we follow in the portfolio, the Chewies, the Zooms, the PayPals, the Rokus of the world, that are up, 20, 25, 30 or more percent off their bottom, where the market's just 4% above its, off of its bottom, right? So that is what we call positive divergence. So whether or not the market's going to make one more final low, right? It's drawing lines on a chart. It's not that easy to make that type of assumption. We look at market action and market activity to try to determine if there is strength. Now, as again a contrarian, the fact that everybody in the investment community thinks that this is an absolute certainty makes us think that maybe it's not, right? Because when everybody's sure of something in the stock market, the market's going to do the opposite. But nonetheless, even if we get a little bit more downward pressure on the indexes, we think a lot of the stocks that we own and hold have already made their bottoms, and we'll be able to put them to that test through this next cycle here to see, do they show that relative strength and outperformance because they have come down to a level where they're relatively cheap. Let's take a look at the S&P 500 heat map over the last week, right? This is the type of leadership that you'd want to see when the market rallies, and this is the type of activity we would expect across our 11 stock market sectors, right? When we have rallies, we're going to see tech lead, we're going to see consumer communication services lead, consumer cyclical, industrials, financials, everybody's participating except for the defensive stocks, right? healthcare, and to a lesser degree, a little bit this week, energy, right? So those have been defensive. They've been the winners while the market has been losing. Now market starts to win again, and you would expect some air to come out of the defensive sectors. Taking a look at investor sentiment, right? The fear and greed index, investors still very fearful. Now we had a reading, I think we got as low as 6 about 2.5, 3 weeks ago on in the extreme fear category on fear and greed index. That to us was an indication that at the very least a short-term bounce was due in the market. We got that bounce, and now everybody wants to know, is there sticking power with this bounce? Is there some momentum to take us higher, or is this rally going to fail like previous ones have failed? And again, we are not too optimistic at this point in terms of fear and greed. We believe that the rally could have some momentum to it. But in terms of the overall market, right, what we don't want to see is a 5% bounce off the lows and all of a sudden we're in extreme greed categories. Right, that would say people are way too optimistic that the worst is behind us. You always want people to be even keeled in the market because that's what makes a market, buyers and sellers, right? An imbalance between the two. But still, people are fearful. Participants in the market are fearful. And again, as a contrarian, this is a good setup for the market. So we'll continue to watch this. We have come off the lows, but we are seeing still elevated readings of fear. So going into next week, what we're looking for in the market, let me just bring this back in, right, is essentially where is the market going to go from here, right? That's what everybody wants to know. Now, we have a level to keep an eye on above, right, a previous area where the market tried to break higher and failed to do so. Let me just make that a little darker so you can see it. So right now we're kind of in the middle of a range that has been carved out over the last couple weeks. And the line in the sand above us, let's call it around 4,300. And we know that line in the sand below us was 3,800, right? That was the intermediate term low. So these are the levels that we're watching, but we've seen some good price action in the market led by individual stocks showing strength. Even today being a weaker day, Friday, market's unsure what to make of the payrolls report. But the market is consolidating very nicely here. After a move off the lows, we call this a flag here. The markets are flagging, kind of building energy for their next move. So we'll be back next week to update you on anything that happens later today and any of those developments, how they impact our thesis. But if you have any questions, as always, reach out to us. Always here to talk to you about anything that matters with your money. Have a great day and a great weekend, and we'll see you back on Monday for the Heritage Market Update.